Ever sat down and wondered why the rich keep getting richer while most people can hardly afford to pay bills? Well, the rich have got certain financial rules that most people do not know. The rules are meant for increasing their money and protection, though many others fall into financial troubles out of ignorance. Let's share with you 5 of these important money rules that rich people would rather you didn't know. So, if that is what you really want to change, your money future, then don't go anywhere. Stick to the very end. First of all, hit that subscribe button down below for more tips on money and investing and making some cash. Number 5. Stay away from banks like the plague. Putting it in a bank may seem safe, but it's just holding back your chance of making more money. In the US, in 2024, this inflation stands at about 3 to 4%, meaning technically that in every year, unless one earns 4% interest, the value of money goes down. Even the biggest banks of the world, like JP Morgan Chase or Citibank, pay only 0.1% of interest on fixed deposits. At that rate, due to inflation, the purchasing power of your cash decreases each year. In the past, banks gave higher interest rates, sometimes about 5%, which was good to save your money. Banks earned an income from lending out your cash at higher rates, say 10%, and kept the extra. But it doesn't need to pay decent rates to attract deposits. It's grown large and powerful, and true competition just doesn't exist. A little regional bank may be paying 5 to 6%, but they're much riskier today than they were when the failure of Silicon Valley Bank showed that even well-regarded regional banks aren't too big to fail. The alternative is to tie up your money in assets that constantly yield returns higher than the rate of inflation, such as real estate or the stock market. These generally yield an average annual return of 8 to 10%, helping to keep the value of your money and actually growing it over time. Rich people know this and make sure their money earns more, rather than having it sit in some low-interest bank account. Number 4. Every bank has the right to print money. Most people do not realize it is within the law for commercial banks to make money. That sounds illegal, but it is a debacle within the fractional reserve banking system. If, for example, you put $10,000 into a bank, an amount equivalent to that will not all be kept by the bank. It holds only 10% of what you deposited and lends out the rest. In this case, an amount of $9,000 has been lent to someone else. Now, a claim has arisen on this money both by you and the borrower, so in essence, $19,000 are now in circulation. The process continues, and eventually, most of the money within an economy will be created by lending it through a commercial bank, not by the government printing cash. While this digital money can be created many times over, that is why rich people know money itself is not where wealth comes from. True richness is having the assets that put money in the pocket, like property, stocks, or a business. The rich know the rule of money within bank premises and are programmed to seek more of those that will generate cash for them than keeping their money in the bank. Number 3. You can make money by borrowing. While many consider debt an evil thing to keep away from, to the rich this becomes a leverage to accumulate more wealth. Poor people borrow money to buy things they cannot currently afford, such as cars or houses. Rich people borrow money to invest in something that generates more money. For example, real estate investors often get a loan to buy a property and then use the rental proceeds to pay off that loan. Over time, they become owners of the property, and any additional rental income is pure profit. Even on Wall Street, the art of making money heavily relies on borrowing. Short selling is one activity that well-endowed investors and hedge funds do. That is, borrowing stocks from their owners and selling them at high prices, so later on, when their stock price plummeted, they bought it and got all the profits from the difference. The method would give them money without too great an outlay on their part. Not all debts would be bad either. Debt taken out with the purpose of acquiring a property values or creating revenue would enrich it thereby. The key to debt is in using intelligently means making an investment work in such a manner as to provide more money than the loan costs. Number 2, it's cheaper to be rich than poor. Maybe it sounds strange, but often, if someone is rich, They get loads of money perks that make life cheaper. Take a rich person who takes out a loan to buy a house. They'll often get better deals, such as lower interest rates. Why? The banks view them as safe borrowers. Typically, a wealthy individual has a multitude of means for gathering money, whether through businesses, stocks, or other investments. In the case of one source that dries up, they still have other ways of paying the bills. Living paycheck to paycheck, a person is obviously more of a risk for the bank. Should they happen to lose their job or incur some unexpected expenses, they most likely will not be able to return the loan. To compensate for this risk, the bank perceives higher interest rates for potential lower-income borrowers as a means of increasing the cost of a loan. The same can then be applied to other areas like insurance and personal spending. Individuals who have money can always bargain for lower prices or secure discounts on buying in higher quantities. This lessens their total cost. It became a self-perpetuating cycle where the rich became even richer, and the not-so-rich found it ever tougher to prosper. Number 1. Credit cards are the bank's favorite tool. Massive sums flow in the bank from credit cards, and for quite a bit of a reason, their interest rates skyrocket. Your mortgage is around 3 to 7%, but credit card debt goes sky high of 25 to 30% or more. Banks will run all sorts of promotions that will promise many rewards points, offer cashback, and free travel to lure people in. Face value might make them sound good, but for most people, their only usage of credit cards is to reap these benefits. The fact is that the costs of credit card debt are overwhelming. Those interests on your debt pile up really fast if you don't manage to clear your balance in full each month, hence making it awfully hard to break free from this vicious circle. That is why banks sell credit cards so much. They know that once the customer has a balance, interest payments on it go high. Good credit is important to maintain. It gives you better terms for loans. The key point here is the prudence of using credit cards. Just make an auto payment on the full amount of your credit card every month and use it only to pay for costs that are easy to manage, such as subscriptions. In this way, one could actually enjoy all the benefits of owning a credit card without necessarily getting into debt. And if you like this video, thumbs up it. Share it with everybody. Make sure to subscribe for more money, investing, and financially free tips. Thanks once more for watching, and I'll see you in the next video.